Flights are pricey, planning feels chaotic, and that family trip keeps getting pushed. I hear it every day from business owners and busy professionals, and I felt it too. I'm Ross, the founder of Itinerary Boss and your host. After 10 plus years of planning work and personal trips to over 20 countries, I became the guy who found the deals and turned points into upgrades. This show helps you turn everyday business and personal spend into points and miles for premium travel. Each week, you'll get step by step tactics and short episodes, plus expert guests with specific use cases tied to your most asked questions for travel plans that'll help support your business, goals, and your life. Go ahead and grab the free Points and Miles cheat sheet in the show notes to speed up your learning. And now, on with the show. Welcome back to another episode of World Travel Made Easy. On this week's episode, I'm excited to have the CEO and founder of Vodacy, Shawn Moore. He's going to talk to you about, if you can see his book, what the hell is a lifestyle asset? Hey, Shawn, how's it going?
Ross, doing good, man. Thanks for having me. I appreciate it.
Yeah, of course, of course. I wish I brought for people who are watching, I wish I brought my cowboy hat that I
I
got at
know. I
Jackson
need you,
Hole.
you need to rock that cowboy hat, right?
No, I know. It's tucked away somewhere. I usually break it out on our annual snowboarding trips, and we're staying in lifestyle assets.
Love it, love it. Hey, that's all right. As long as you have one, I'm impressed that you have one. So that's good.
Yeah, I scooped one up when we were out in Jacksonville, not Jacksonville, geez, Jackson Hole snowboarding, and
Nice.
rocked that bad boy out, the $1 Million Cowboy. So I
Heck yeah, I love it. The old $1 million cowboy bar right there.
It is a good time. But yeah, would love to just give the listeners a little background about yourself. What is Vodacy and how did you get into real estate?
Yeah, so I've been, man, it's been a long time. I feel like there's lots of gray hair in that, in the facial hair there. So that you can tell I've been doing this for a little while. I've been full-time real estate investor for 26 years now. And it's all that's really ever paid my bills right out of college. Got involved in fixing and flipping houses and kind of evolved through a number of different asset classes. And through that time, mostly in the residential space, didn't do a lot of commercial or multifamily. I've done most of my work in the residential aspect of real estate, whether fix and flipping, developing single family communities, building single family homes. And then back in 2006, I stumbled into buying some vacation homes and not with the intention of renting them out. But then when everything started kind of getting shook up in real estate in 2007 and 8 and started, realizing that, man, I'm not making as much on my development deals as I thought I was. We ended up trying to rent out our vacation home. And so, and it did really well. And it did really well for the next 3 or 4 years through some of the worst real estate times in my investing career was that Great Recession. And it was kind of an eye opener that there might be something to this. This was before Airbnb. This was before Airbnb was even a company. And so we were just using Craigslist and local classifieds to rent these properties out on the weekends. And ultimately, fast forward a few years, back like 2011, 12, we really started to kind of take note of, man, there might be something to this. And it was kind of a fun asset to own. They were fun properties to buy, fun properties to use, and then also make money with. And so we've kind of been, fortunate to see the short-term rental world grow up and become a mainstream asset class really before our eyes, being in this game, as just kind of an alternative, not really recognized as an asset class. Now it's very much a mainstream asset class, very much something that you look at with very intentional, use of as a short-term rental for investors. And so it's been a lot of fun. It's been a wild ride. We've seen the wild, wild west back, pre-COVID days, right after COVID hit, and then things becoming more and more regulated. The markets kind of, introduced themselves to the mainstream world right after COVID, and everybody thought it was you know, the the end all be all, real estate investment. Because if you had a short term rental, you were making money hand over fist. It was like having toilet paper during COVID, and that was never going to last, right? It was never going to, that was never going to be a long term thing. But it's funny to me always looking back how many people thought that this was just, we're always looking for that big hit, right? That big score, and I think that a lot of average everyday investors thought that was going to last for a long time, and it's been as we started Vodacy, I wrote a book, What the Hell is a Lifestyle Asset, kind of taking people through the fundamentals of owning, buying, and building these portfolios and really, the pros and cons of it. Every asset class has pros and cons, including short term rentals. And we try to help people understand what those are. But it has been it's been really interesting because I wrote the book back in 2017, have revised it since, but the fundamentals have been the same ever since, right? And so, but there were the fundamentals, we forgot about them for a couple of years after COVID, and then, as you know, I know you own a few properties yourself. A lot of real estate investors have been in the game for a long time now. Look and say, well, we knew this was going to happen. We knew this wasn't going to last, right? And it's the short-term rental game. A lot of people think it was the golden age is over. I disagree with that, but it is definitely a game that you have to play and understand how to play, just like every other asset class. And that's what we do at Vodacy, is try to help people walk into that this asset class, this game, with their eyes wide open.
That's awesome. And you guys have, I love how you've been in it 26 years. So you have that experience. You've seen it. And there's a good book, The Upstarts, that I read. It's about Airbnb, Uber, and like you kind of see over time like how that became. But it's very cool to hear that you guys were like before the Great Recession, you were starting to learn that, and you're like, you know what, we're on to something. And you were, but what sets you apart from a lot of people in the golden age, during that COVID time is you're a smart operator, and that's usually what's going to happen, right? Is you've kind of seen, you've been before that, you were doing it when it was, we'll call it pen and paper, right? Before, right? You had the technology to be able to leverage it with, different things, but, it's kind of like, lenders, agents, investors. It's like when the going was good, everyone was, just getting just very happy with it. But when you had to really start to dive deeper and become a better operator and there's competition, that's where, like you said, right? If you know what you're doing, if you've put in that work, you're going to kind of realize exactly and what you need to do, and you're going to be one of those people who's going to be successful and continue to share and help other people do that. So,
Yeah.
so that's awesome. What is because you're talking about lifestyle asset, for someone who likes to travel, obviously. A lot of our listeners are travelers. They're financially sound. They want to learn more about investing. What is a lifestyle asset, and then what makes it a little bit different than maybe some other real estate investments?
Yeah. So lifestyle asset is, our definition of it is, and I think we coined the term lifestyle asset a long time ago. And it's used a lot now, but so my definition of a lifestyle asset really has three things. One, it can't be a second job. So these are assets that I need to be able to be profitable with, that other people can manage. Short-term rentals, one of the Achilles heels of the short-term rental investment themselves, are they're high touch, high management, high up. Like there's a lot of management that is involved in operating a portfolio of short-term rentals. I don't manage my own properties. And so when I'm looking for a lifestyle asset, to me, a lifestyle is going to up my lifestyle, which means I'm not adding to my workload, right? And so I need to be able to find profitable properties that are investable, that can handle not only all the debt service and all the fixed and variable expenses, but adding management on top of that. And that becomes, a little bit more difficult to do, if you will, when you're underwriting properties. But that's one of the two criteria. The first two criteria is, one, it has to be profitable, and two, somebody else needs to manage it. They kind of go together, right? I need to be able to have both of those. And the third aspect is, I want to buy properties I like to use. And so there's, this aspect of short-term rentals, just as strictly as an investment, is great. They're very much a viable investment and can be underwritten even if you don't ever use them. But that's not why I started doing it. I love having a portfolio that we use with my friends and family. It's an intangible return that's not measured.
Hey, I wanted to take a quick break to say thank you so much for tuning into the show. The only way the show grows is through listeners like you helping us share it. So if you're enjoying the show, it'd mean the world to me if you hit that 5-star rating, shared it with a friend or family member who's ready to travel more, save money, or just needs a little bit more inspiration and that nudge. And if you're posting about it on Instagram, go ahead and tag Itinerary Boss, and we'll make sure to reshare it and shout you out for giving us a shout out. Thanks so much for the support. It truly means a lot. And now back with the show.
On paper, but we're able to go out and enjoy these amazing vacations, and we're able to share those with our friends and family. We send our friends and family to our properties all the time, and they get to enjoy them. And so that's where I call them a lifestyle asset as well. There's that personal use aspect that becomes really, really fun. And now that also comes with a drawback on the investment side, on the dollars and cents that you're putting in your pocket. So you have to strategically know when to use them, when not to use them, when to maximize that asset for, for its income earning potential, and how you can really, not maximize it by using it during some of those peak times when you should let other people use it. So we usually typically are going to use our properties in the slower seasons, maybe some of the off seasons, the shoulder seasons, because it doesn't cost us as much to use them. Because in fact, I've got a property in St. George that I haven't been to in almost 3 years, because I've been down there, and every time we go down there, I rent my next door neighbor's property because ours is renting for double what he charges me to rent his. And so I'm like, I don't even stay in my own property down there because we strategically have to navigate that. But lifestyle assets shouldn't be a second job. They shouldn't add to my workload. They should be profitable. I should be cash flow positive on them, and I should be able to use them. And all three of those things add not only to my financial stability and my financial, increasing my financial independence, but also my lifestyle independence.
Yeah, no, I love that. And I think for a lot of people, they always think through like, hey, I want to, create memories with my family and I want to invest in real estate, but I don't want a second job. And, it is very high touch. I mean, we stayed at a friend's short-term rental um, at the Bourbon Trail this past weekend, and it
Yeah.
was, it was awesome. But at the same time, there were just a couple things where I was texting him because he was like, hey, give me feedback. We're getting on our direct booking site. And like that's high touch. We sometimes run, for when we have some vacancy here over the holidays, if we have, we do mainly medium term because that's less touch.
Yeah.
And we've gotten a house hack though, so that was a little bit of a lifestyle. But just it is a lot of work. So from just thinking through that, I love that because yeah, you can create those memories with your family. You also have somewhere where it's big enough. You're not like, okay, we got to go find a hotel that's going to fit everyone. Or, if we want to go during peak season, book this. I think that's another good point that I always like to tell people is, you know, you're either going to get a good deal if you're going somewhere different, you're flexible, or and your flexibility could be shoulder season, right? And
Yeah.
that's a huge,
Yeah.
huge way to get a good deal and go when it's not as crowded. And a lot of the times
Exactly.
that leads to a better experience. So for you guys, you probably have more peace and quiet where
Yeah. I don't even have any desire to go to my properties during peak season, because that's exactly how I feel. I'm like, I want to go when the crowds have died down, when the restaurants are open, when the locals are out, and I just want to just go. There's a lot more peace and quiet in those areas. And I love our properties in the shoulder seasons. It's my favorite time to go, and don't even really care that we go during the peak season. And that's great because that's when we make all of our money.
So that's the strategy right there.
Yeah.
You got to just go during the shoulder
Yeah.
season, then peak season, rent it out.
Yeah.
Where are some of your properties, just so our listeners have a better idea?
Yeah, so we've got some in Florida, got some in Georgia, Utah. I got a number in Utah, Arizona, and so I usually keep Ross somewhere around 6 to 8 properties. That's another thing that is interesting about this asset class is you can. It's not, though, at least my philosophy on this. It's not a quantity game; it's a quality game, right? And we're also trading up and looking at our return on equity over the years, and so it's not that I've only ever bought 6 properties and I've held them forever. What we usually do is turn them every 5 to 7 years. And so we'll trade up. I just sold one, actually closed on it yesterday, that we're trading up in St. George, Utah. We're going to place that money into Scottsdale because we've maximized that asset over the last 5 years. It's more than doubled in value. We're maximizing the revenue, and my return on equity is going down because of how much value I have in that property now, not because my initial investment was great and it's been a great return on my initial investment, but now I've got to look at how much value I've got in that property and it's just parked there. And so I'll look at it and say, hey, instead of having this property that I bought at 3, sold it at 7, and now I'm going to say, okay, I'm going to take that property, I'm going to take that equity, that extra $400,000 in equity, and I'm going to go buy $1 million property, and then that million can grow to 1.5 million, right? And then I'll take $900,000 in equity and then go place it into another. So we do that over time, and that's where you can have and hear of portfolios that are 4, 5, 6 properties that are making and netting $1 million a year. The misconception is that it's the first 4 properties you bought are making you $1 million a year. That's not the case. Those portfolios that are performing at that level typically have been traded up into a few times.
Yeah, no, that makes sense, and I appreciate you breaking that down. Yeah, from a real estate investor standpoint, like that's my mind is always thinking that way. But I think for a lot of people, like, how do they get there? And then what
Right.
do you just hold that for 30 years? And then how does that work? And do you stack them? And I think you answered one of the questions just around, time commitments, energy that goes into it because you have 6 to 8 properties versus 30 that you're just stacking over years. Are there
Yeah.
any destinations that people, if they're just getting into this, you like to say, hey, this might be a good destination for you to look at? Or is it on personal preference? How's that look?
Yeah, it all goes down to what their actual property goals are. And it revolves around really, two major things, three things, right? Is why are they buying this property? What kind of portfolio are they trying to build? Is it more of a lifestyle asset or is it more of an investment, right? If you're like, hey, listen, I really want a lifestyle asset. I want a property that's more of a legacy property for our family. We can use somebody else pays for it. I'm not making a ton of money maybe on it as an investment. And but I'm going to be very specific about the area or the property that I'm going to buy because it's going to be our family home that we're going to use, right? And so there's those types of investors. There's a lot of those types of investors out there. I'm going to suggest different markets for those types of investors than I am for somebody that says, hey, Shawn, I'm really looking to maximize this portfolio from an investment standpoint. So I want the most investable markets. We're looking at ratios between acquisition costs in areas versus the revenue that their potential revenue to generate on these properties and put them in a really favorable position from a cash flow perspective, but also from an appreciation perspective, because there's usually an inverse correlation between the two. The highest cash flowing areas are usually lower appreciating areas. The reason for that is because usually you get higher cash flow because your basis is lower, right? Your purchase price is lower when you buy these properties. Well, lower purchase price areas are typically historically lower appreciating areas because if they were high appreciating areas, you'd be paying a lot for the property, right? And so, you go into some of these expensive areas, they're not going to cash flow as well, but they're also over a 5 or 10 year time horizon because they appreciate at 6, 7, or 8% instead of 3, 4, or 5%. You look over that time horizon, you're like, holy crap, that was a way better investment for me as a wealth building strategy. So there are some investors like, hey, listen, I'm looking at a 5, 10 year time horizon and it's more of a wealth building strategy. I'm going to suggest different markets for them than somebody that's saying, hey, listen, I'm really trying to replace some income right now. And I'm looking for a higher cash flowing portfolio so that I can maybe quit my job or I can walk away from something or replace certain income. So we're going to then go look at some of those markets that maybe don't appreciate as much, but give them more in their pocket every single month. Does that make sense? So there's
Yeah.
when
Yeah.
I hear, and I always roll my eyes when I see the top 10 markets or the top 100 markets and everything else, because it's musical chairs. And right, the consumer wants to see those best markets. The best markets are based on what your actual property goals are. And then we will look at some of the markets that are producing the number one thing that you're looking for when it comes to your property goals, whether it's long-term wealth, cash flow, personal use. And a lot of times it's a combination of all three. We want all three, right? But there are things that we need to lean toward depending on what is most important to us in certain markets.
Yeah, no, perfectly said. And I think it's like thinking about, San Diego, everyone wants to go to. It's landlocked. They're always right. It's the weather. It's like Anchorman, where the weather is
Yeah.
it's 72 degrees. It's great, but everyone wants to move there, and there's not a lot of dirt to build on. So that
Yeah.
equity is going to be rising. And then, like you said, I love what you said about the top 10 markets because you get that, and it's like the Midwest is the hot market. I'm going to dog in Ohio for a minute because my wife's from there, and I can.
Yeah.
But like if you go when you go there, it's you're going to deal with snow, you're going to deal with older homes. Like, yes, those are good places. There's opportunity for maybe cash flow, but there's also, it's not going to be brand new buildings similar
Yeah.
to some of the markets like Charlotte, where we're continually building. It's you're
Yes.
going in and you're fix and flip. You're going to have some of those hidden costs, and the equity isn't going to rise. And I'm from Northern Virginia, where, yeah, that was a very good appreciating market because the demand was there, the government's in DC. So it's like, I love how you broke that down. And it kind of comes back to what are personal goals? That's the same thing in travel.
Yeah.
People always ask, what's the best credit card for me? And I go, how much time do you have? Because
Yeah.
for
Right.
me, if you're single and you're 20 and you just want to go travel on points and go kind of wherever and your schedule's easy, it's going to be completely different than a family of 3 or 4 where most of your money, if you're not a business owner and you don't have like a lot of your money going towards ads and materials, whatever, your business is, it's probably going to groceries for your
Yeah.
kids and family, right? So it's like you always got to put yourself in that position and think through, okay, what are the personal things that matter to me most? And yeah, we have a family lake house that my grandpa bought 25 years ago in cash because it was so cheap. But now it's like do we sell that land or do we keep it? We've had the memories, but it's like everyone's older, it's getting older. There's a lot of work that needs to go into it. And that's definitely a lifestyle asset because we spent 25 years of summers there,
Yeah,
but now it's like everyone's kind of scattered around. So you have to think through like those are some of the decisions you have to make. So no, I
exactly.
appreciate you breaking that down.
Yeah, and it's never a one size fits all. Unfortunately, online with marketers and everything else we try to think that there's this one size fits all. Oh, here's the best property, or this is the best market, or I'm going to find you this deal in 30 days. And we've never done that. Like, because I realized how many layers of the onion you have to peel back to make sure it's the right property. People always ask me what's your success ratio within Vodacy, and I'm like, well, kind of how much time do you have, right? We have 2,000 members and they all had different property goals. Where are you defining success based on what? Like, did they find a property that met their property goals? That's how I would define success. But a lot of people are like, well, how many people are making X amount of money? And this, it's like, well, that's not always what everybody's goal is, right? And we want to find and build a portfolio that works for your property goals.
Yeah, 100%. I think you touched on it perfectly at the beginning. That's why I asked the question, how long you've been doing it? 26 years. It's the long term, and I
Right.
think everyone wants the quick hit.
Yep.
What's the quickest way to make as much cash as possible? And also, yeah, that's a lot of the times just like learning those things over time is going to help versus, focusing on what's hot now.
Exactly.
Are there specific things? So I know you talked about like, people's preferences, those type of things, but just from like a financial standpoint, are there when you're talking to people who are, interested in Vodacy, people who have come on board, are there 2 to 3 things, you want people to have in place before they even think about buying a lifestyle asset?
Yes, great question. I appreciate you asking that one. And so, star for Ross on the question, because it's one of the biggest mistakes that I see people make is they walk into this game without realizing what it actually takes. First, I'm a big believer I'm an old school guy, right? I'm a big believer. I'm very conservative. It's funny because my dad's like, "Man, Shawn, I could never do what you're doing because it feels so risky," right? And I'm like, I feel like I'm the most conservative guy that I talk to on the investment side. But there's investing is like the third aspect of what you really should be working on. A lot of people come into this and they look at investing to replace income, right? And so a lot of people have income problems. You need to work on your income problems, and that is not usually investments. So if you've got an income problem, work on the income, make more money, have a side hustle, do whatever you have to do. The second aspect of that is savings, right? You need to be making sure that you're used to living off of less than you make, right? Being able to put some money in savings on a regular basis. I loved when investors come to us and they've already got the habit built of they're making more than they need every single month. They're taking that excess and they're saving it every month. Then they're ready to invest. What I think people do is they're lacking on savings, they're lacking on income, and they think, well, I'm just going to go buy an investment that's going to solve all my problems. It's not the case because these investments are expensive. And there are times and months that you're not making your mortgage payments or the income's not making the mortgage payment. You've got ups and downs and you've got all these different things that are happening with these investments. And what if everything doesn't work out perfectly? You're not really in a position to invest. So outside of that, let's say you're in a position to invest. You need to make sure, specifically with short-term rentals, I love them. It's where all my money's at. But one of the drawbacks is they're very capital intensive on the front end. And even if you develop the skill sets, and we do all the time, of owner financing, subject to deals, zero down deals, all those different things, we use conventional financing all the time as well. So we put money down with banks. But so let's say there's 3 things you have to make sure you're ready for. One is the down payment. And so that can be depending on what type of a loan you're going to do. If you're able to get no money down with seller financing, great. It eliminates some of that money, but you got to be able to be ready to put money down to buy these properties. And usually somewhere in that 10 to 20% range if you're buying traditional financing, going to a bank and getting a loan. The second piece, and this is where the majority of investors fail and why we are able to dominate most of the markets we go into, is that setup and furnishing cost. And that setup and furnishing cost is, we have to realize the game we play. We are in the experience business. We're not in the house business. We're not in giving somebody a model home business. And where there's a lot of really nice homes that are set up like model homes that just become commodities in the short-term rental space. And so what we do is we're going to budget even more than just furnishings to create these immersive experiences. And we know that we're going to get a return on that, but it's expensive because those are things that we have to pay for on the front end. Many times we use credit cards and we try to use all those points because it's a pretty large expense when you're setting these properties up. Many times as much as or more than your down payment's going to be on a property. And this is where a lot of investors walk in and they say, I'm going to buy a short-term rental. It's already furnished. I don't need to do anything else. And they buy this model home, right? They buy a model home and they budget for their down payment. They launch it. It's in a great market. It's in a good location and they don't make any money. And they're like, man, why is this not making money? Because they forgot that they're selling an experience. And those of us that didn't forget that are crushing them in the market, right? And the consumer is saying, hey, I want this property over this one because it's actually giving me a great experience. And they spent a little bit of extra money here, which is why you see a lot of these short-term rentals at the top of the market with your resort style backyards. They've got these really immersive experiences, bringing the area to life, things that you would never see in a regular home or in these short-term rentals that we do. We call it our Vodacy signature recipe. You would never do what we do in these homes. You'd never furnish them. You'd never put the artwork that we do in your own home because it would just be too much, right? It would be like walking into Disneyland every day. And you're like, man, it's fun while I'm here for a week, but I can't do it all the time. And so that second piece of budgeting is a big piece where one, a lot of the competition just eliminates themselves. And two, the ones that don't eliminate themselves really put themselves in a position to succeed long term because they created, and we call it an immersive experience and invested in that, but it costs money. Those are not things that you're going to finance with the seller. Those are not things that the bank is going to loan on. And so that's when they listen to your podcast, Ross, and say, how do I figure out how to get this money zero down and or 0% interest and for X amount of time and get my points and everything else. So you get those benefits. We play that game all the time in that when we're furnishing and setting up properties. And then that third piece is making sure that you can get from that when you buy it to that first 6 months, because it's going to be very limited income during that first 6 months. And a lot of people put their backs against the wall because they expect it to make money right out of the gate. And these properties take some time to launch. They take some time to establish themselves and get those first bookings coming in, reviews, and all those different things that happen to kind of launch a property. And so they've got to make sure they can pay those payments for a little while. And that's where that first part of the conversation, this is a way long-winded answer, I apologize. But that
I
first
love
part of the
it.
conversation is saying, making sure that you built the habits of earning, saving, and then being ready to invest.
It's no, but I love how detailed you got into it because that's the exact process like that I went through when I started like at 23 started budgeting, right? Investing, realizing from a real estate investing standpoint. I got asked this question on a podcast recently was, when I was talking about credit cards points, like when is the right time to start investing in real estate? And exactly what you just said was pretty much the answer. It was like first you want to make sure you're budgeting right. If you're wanting to invest in more expensive assets where you're going to need that, you want to have that emergency fund, because
Mhm.
if you don't go buy a brand new property with a new home warranty, things happen. You have,
Yes.
10,
Yep.
$15,000 HVAC thing, systems.
Yep.
There's other expenses that could come up. So it's first, right, budgeting. And then on the furnishing side, yeah, those are things that you have to put into place on the front end. And those kind of how this really got started in focusing on helping real estate investors was I went through that process of I like to travel and I know how I did this for my personal home, right? When I moved down and got a welcome bonus for my first property. Now, how do we do this with investment homes? And yes, we have the cash, but why not get a 0% interest card so we
Yep.
can have that as a safety net, right, for other properties and take calculated risk, right, to have some of that. But it wasn't okay, let's go buy, 15 properties in 6 months. And I think that's where a lot of people in what we were talking about, 2020, 2021, 2022, who went as fast as possible and bought all these and furnished them the wrong way and overextended themselves, they're the ones who aren't doing as well. And I listened to Real Estate Rookie with Tony Robinson. I'm actually going on their podcast next week and just
Mhm.
talking through that. And something that he talks about, and even Rich Summers, who I listen to more on the commercial side, is like their Airbnbs, they're investing a lot more money. They're not going out and buying more. They're putting a lot more in and making those better because that's the type of experience that people want. And yeah, just being at the Bourbon Trail last week, it was like when I looked at them, like, this is amazing. You got the hot tub, you got what we need in the back, you got, everything, the artwork. I feel like I'm at the Bourbon Trail in the house. Like it's
Yeah.
this this is set up perfectly. But yeah, I think it goes back to that and just parlaying it into travel. It's same thing. It's
Yeah,
really just
exactly. Yep,
budget,
exactly.
credit
Yep.
cards, don't overextend yourself, make sure you're paying those off on time. Like it all comes down to putting the right things in place from the get-go.
Yeah, and it's looking for those basic disciplines on the front end, which is what I was talking about. Like, listen, live below your means, put money in savings for a period of time so it becomes a habit, and that's just how you do things. Because all of those things you're talking about and of being able to get these cards with 0% interest and get the points and being able to parlay them to different cards and move things around, all that takes that discipline, right? Because you can quickly get yourself into big trouble if you don't have the discipline, and the discipline comes first, and then being able to say, hey, listen, now let's go take advantage of this. I talk to people all the time about an all-in-one loan, and we use those a lot, and they're basically first lien HELOCs that you put all your money into. You have all this money, and you basically can pay houses off in 6 or 7 years, just doing the same things you normally would do on a 30-year loan. But it takes a lot of discipline not to screw it up. And so you have to live a certain way, and you have to be able to be disciplined with your money a certain way. And when you do, you can really start to maximize the benefits of all of those strategies.
Yeah, and it just goes back to what you said on the front. It compounds over time. Like
Yeah.
you 26 years ago, I bet you wouldn't have said all of this, right?
Right. Exactly. No, no way. Right. I mean, I was the guy that was like, no, I want to move as fast as possible. I was the guy that was like, I want to give me 3 investments so I can quit my job tomorrow. And I thought that's how everything worked. Right. It is
But
totally different now.
yeah, but I think that's what people see online, and
Right.
it's like you get into it and you're like, oh wow, replacing this with cash flow. Like you need a lot of cash flow, and you got to be, you have to have something that's bringing you in a significant amount. But
Mhm.
yeah, this for me, 10 years. I mean, it took from learning different cards, having the budget in place, slowly investing, making the mistakes in real estate, learning from those, right? And over time you learn those, but it doesn't just happen right overnight. It happens from listening to podcasts like this, other ones you go on,
Yeah.
right? Following the right people. Yeah, no, I love the long-winded answer because it got it it hit home to something I just talked about on another podcast. Are there, you know, because I think something you brought up a good point. You have people who they might be business owners, where they probably a lot of the times you want to focus on your own business and growing it. You also have W-2 employees where sometimes they're looking for the tax benefits. Is there a strategy that you recommend for either one of those people, or are there ways that they can passively invest with Vodacy?
Yeah. So one, we try to, most of my clients that I work with at Vodacy they are business owners or high W-2 income earners, and they're pretty busy. They're not looking for a side hustle. The thing that I teach that a lot of people don't teach, and I understand why they don't, is most people teach you to build these portfolios, manage these properties yourself, because management, when you look at your pro forma, management is going to be your largest expense, and sometimes more than debt service, because it's taken 20 to 30% right off the top, right off your gross revenue. And so for a business owner or a high W-2 income earner, they don't have a lot of extra time, right? And so they need to be able to build a portfolio that they're not managing themselves. They're not having a second job. It's not a side hustle. And so we're willing to trade that 30% off the top of our gross revenue to a management partner so that we can continue to invest for the long-term benefits of home ownership, right? My strategy really doesn't make any sense to do co-ownership or co-hosting or arbitrage or anything like that. I don't teach that because those are more side hustles, and it only works if you're managing the property. You're basically getting paid to manage somebody else's property. So my clients that we talk to goes back to the high W-2 income earner or the business owner. They're looking for multiple levers of returns, right? They're saying, how can I capitalize on my active income that I'm making and I'm working so hard to make, and put it into something that one I enjoy, which is why they're attracted to short-term rentals. They want some sort of usage out of the property, and they like to buy quality assets in quality areas that they can enjoy with their friends and family. That's why they're attracted to short-term rentals or lifestyle assets. But then they're saying, okay, I don't necessarily need to worry too much about the cash flow, but I do want the appreciation. I want the tax advantages so that I can start to parlay these into other properties. And so the conversation for both of those groups is, again, what is their property goals? Most of the time, it's going to be a longer term wealth building play. And when that's the case, you can really spell out all of those major returns. You got four major returns with any real estate investment. One is cash flow. And so it's like, and that's what most people focus on with real estate, right? Is just what is my cash flow? It's usually over time your lowest return on your investment, right? The second is your note pay down. Somebody else is paying down that note every single year for you. And that's going to equal somewhere around that 5 to 7%, probably in those first 5 to 10 years of ownership. So you're getting about 5% of your note paid down every single year on a regularly amortized 30-year mortgage at 7%, right? And so that's another nice return because that's actual added equity. The final two are the biggest returns. The third one is your appreciation. And so, average with real estate over, 40 years in the US is about 5%. And so if you look in every market, we talked about regional markets, real estate is very regional. So it's different in different markets. But if I buy a $500,000 property and I put $100,000 down because I put 20% down on it, that 5% return I got on that property gave me a 25% return on my $100,000 because that $500,000 property went up to 525. I just got a 25% return on it. So just from let's say I cash flowed 5% cash flow, 5% note pay down, 25% return with a 5% appreciation. That's a 35% return on my money every single year. Those are pretty hard numbers to beat in a lot of other asset classes, which is why people love real estate. However, the only thing I'm really realizing in my pocket is that 5%. And so a lot of people immediately will look at that and say, I'm going in another direction because I can do better than that. Right. And then that fourth one is your tax savings. And with short-term rentals, with 100% bonus depreciation back and understanding the short-term rental tax loophole and everything, that can be another significant return on your money. And it's only a one-time deal. So that 35% that we're talking about every single year, that 5%, 5%, 5% goes, that equals a 35% return. I get that every year. That fourth one, the tax one, depreciation, especially if you bonus depreciate in that scenario, $500,000 property, conservatively, you're gonna have a cost seg of about 25% of the purchase price. Which means that's going to give you a write-off against your active income as long as you materially participate. So if I get a write-off of $125,000 at a 30% tax bracket, I'm going to be somewhere around 40 grand. That's another 40% return. So year one, I just made 75% on my money, right? That's tough to do. And so when you're talking to high W-2 income earners and you're talking to business owners that are looking for a wealth building journey, they're saying, hey, listen, I spell this out for them. I'm like, these are just base hit properties. We're not going and crushing it on cash flow. We're not crushing it on appreciation. We're not crushing it on the taxes, but all those things add up to a pretty significant return on that investment. And then we just rinse and repeat. And they're pretty happy when you fast forward 5 to 10 years.
Oh yeah. Yeah. And with bonus appreciation, come back to 100%. Like that's
Huge.
when people start to realize that and what you can do, that's where and people always think through like, how is someone getting this for tax break? How are they then pulling that forward? How are they getting to these numbers? And you just spelled it out super simple. And I think I love what you said about the cash flow part of people see that and they're like, oh, I'm only making, a couple $100, I'm good on that. I took my mindset out of that. I'm like, hey, that's gravy on top for a rainy
Yep.
day. I'm really worried about the other three. And
100%.
yeah,
The other ones are just, and that's where real estate, and that's why people with a lot of money put their money in real estate because of those other three aspects of it. And it's really hard to beat. It's hard to beat. And it's tangible. It doesn't drop by 30% when somebody tweets that they're raising tariffs, and then it doesn't go up the next day when they're coming back, right? It really doesn't matter, right? And so it's like it's not as volatile, which to me is a nice peace of mind for a long-term investment, but I can use the whole time too.
yeah, yeah, 100%. I love it. I love it. Are there any, because I know we talked about shoulder season, going to places, hanging out with the locals, and being a small business owner, right? You always want to support those local businesses. Why does that matter for you as a host, for guests, but also, other owners that come through Vodacy?
Yeah, I think it's huge, right? A lot of these markets are destination markets. They're small towns, small business owners. They are, they rely on tourism to support their businesses. We are a big supporter of, first of all, we believe that we create a better experience for our guests. Because when guests come want to visit our properties, they want to experience the area like the locals. They want to experience the local flavors. They don't want to go to, a chain restaurant. They want to go to the little boutique restaurant that the owners have been there forever, right? And so what we do is when we invest in areas, we go to those local shops, the local artists, the local service providers, and we say, hey, listen, we've got a property. We want to feature your property because we love to help our guests with itineraries, things they can do, things where they can eat, different activities they can go enjoy. And we really like to support the local businesses. They love that. They very much appreciate it. They appreciate that we come and ask them, because short-term rentals, and especially recently, have gotten a bad rap, especially in a lot of those smaller local municipal areas, with the municipalities trying to slap a lot of regulations on short-term rentals and say, hey, we don't want them here. Well, the local businesses do, because it supports them. And you want to be a good neighbor. You want to be there saying, hey, we want to come in and raise, raise the bar for, your guests. We want our guests to experience what you have to offer. And it's a win-win for everybody. Our guests love it. The local businesses love it. And you become a good neighbor, not just somebody that's there as an investor that's just trying to squeeze every dollar you can out of an area and run it down and leave it dirty and everything else. Like, right. That's kind of the rap that in some of these areas in the peak season, it feels like that, because there's so many guests that come in, and these local communities are overwhelmed. They don't have the infrastructure for it. And so you want to go and say, hey, listen, there's going to be some inconveniences in some of these areas for sure. And it does need to be regulated, and it has been getting better. I'm not one of those guys that says that these areas shouldn't be regulated, because a lot of the infrastructure is just not there. But what you can do is help those local businesses get on your side by supporting them and being able to promote them as much as you can. And your guests love it too, because your guests love to go support. Our guests do love to support the local businesses.
Yeah, no, perfectly said. And I think what I've seen over the years too is now, whenever we pick Airbnbs, if we're not staying on points, hotels, it's okay, what are their ratings first? But then also when you get that check-in or you get those recommendations, it is, hey, here's where we like, here's our recommendations,
Yep.
right? And the hosts are going back and forth. And just even when we were at the Airbnb for our friends, rental, when we were at the Bourbon Trail, like the my father-in-law went over to get wood to do the fire, and then the neighbors were like, oh, we're so glad that this person bought here, like it's great. and
Yeah.
then and then they were saying, oh yeah, the neighbors so it's just like, if you are very upfront and just like, hey, I'm doing this, also like here's my number, I'm right, like it's not just, hey,
100%.
let me make as much money as possible
Yeah.
and whatever, screw the neighbors, right? It's
Yeah.
it's you're doing that to help others, like that's the best way to go about it.
Yeah, for sure. And neighbors, and you brought up a good point with the neighbors. We always go to the neighbors. We tell them what we're doing. Say, hey, listen, we do not want parties here. We tell them all the things that they don't want. We say we don't want it. If you see any of that stuff, like we don't want parties. We don't want people zipping in and out of here. Like this is built for, we tell them who our target audience is. And we want to make sure that we are a good neighbor. If you have any problems at all, you call us. And that doesn't lead to a whole bunch of phone calls. It leads to, man, thanks a lot. Appreciate you thinking of us. We do live here full time. And so like nobody hardly calls us with problems, but just knowing that they can puts their mind at ease like crazy.
Yeah, and then they like you, and you get to text them and say, "Hey, ours is renting for 2 or 3 times this during peak season. Can we come stay at yours?"
Exactly. Exactly. It's exactly right.
I got one last question for you. I got to throw you on the hot seat since we're
Okay.
talking
Love
points,
it.
miles, credit cards. But just you talked about, right? You guys have used credit cards to furnish properties. Are there smart ways that you guys have leveraged those just during the furnishing process? If it's like a creative deal where you're paying for any other cost, or anything else that you've been able to maximize those points and then parlay that into travel?
Yeah. So, I'm one of those set it and forget it type of a guys, and we do spend a lot on setting property up, furnishing them. I am American Express points guy, and so like at this stage, I've got like almost 6 million American Express points. Like I've got all kinds of
Else.
points, lots of those points. But I do. So I use my card for everything, right? Like I don't have anything that does not go on my points card. And so and then we just pay them off. I pay mine off every week. And so I use it, pay it off every week. So we don't even pay interest on it. I have some of my members though. In fact, I had a podcast on one of my members, and he was going through his strategy of what he was doing. And he would buy the properties, he would get the points with the 0% interest plus some good solid points program ones, and then he would use them, furnish them, get all these points, and then he would get these introductory bonus points for new cards, and then pay them off with the old cards, and it was he would parlay it a few different times, and one his example, his furnishing and setup was about $150,000. He ended up walking away with almost 1 million points by doing parlaying and getting bonus introductory offers and different things from $150,000
Yeah.
setup, and it had almost 1 million points at the end of the day. And he walked through it on my podcast, and there was a lot of there was a lot of moving and cards and everything, which I'm sure that you've done that before. I'm more the guy that's like, I've got 6 American Express cards, and what I'll do is get like the one category that gives you 4x points, right? And I'll use that up till my max, and then I'll use the other one till my max. And so I'm trying to get, I'll parlay that way, but that's about as fancy as I get with it.
I love it. You're doing it right. You know what you want to do. You know the 4x cap. Like you're doing it right. And you have those points. So yeah, like we love, and same thing. We aren't spending nearly that much, but when we did it, like one welcome offer for one property got us 100,000 chase points, parlayed that into business class seats at over $5,500 for to go over to Thailand. So like just that's
Yeah.
where the fun is, and that's where I think a lot of people, and I've started to, I have a product integration, Melio, if you're familiar with them, if
Mhm.
for
Yep.
contractors who don't take cards or anyone, because I think that's a big challenge in the real estate space is you want to do a rehab, you want to get painting, any of that. And we ran into that. And that's where I'm like, I got to get points on this, right? There's no way I can just cut a $5,000 check without getting it. So giving helping people realize that, whether they're flippers, developers, and there's people who spend, 2, 3 million just through ACH, and they're missing out on, for three partners, they could be going on multiple trips a year. And those are a lot of the times the clients that we're helping. But it's also understanding, hey, you can go to your vendor and say, hey, if we pay you through ACH, like, could we get 3% off? And
Exactly.
they say yes,
Yeah.
and then that negates the 3% fee. So then you're coming out net what you were going to spend. Oh, and then also you're probably getting a couple 100,000 points a month that you and then you can go use for travel. So it just depending on what you're doing, whether it's developer, whether it's flipper, whether it's just furnishing small properties, like, and just using those strategies. So I love to hear that you're doing that right and earning those points.
Yeah, and it's pretty fun. Like on my kid, like we use it. I do it on American Express, but Salt Lake's a Delta hub, and so we're always flying out of Delta. I used to just get all Delta points, but it's I always now just park them in American Express, and you get a 1-to-1 ratio when you transfer them. But that's all I use it for is travel. I use it for, but like last year we went to London, and there's 4 of us on Delta One, and those are $15,000 seats
Yeah.
for 4 of you, right? I mean, it's a $50,000 trip to go over there. And every year we go to Hawaii, and my kid, like we fly on Delta One. My kids have never seen anything but first class, but it's not because I'm paying for those tickets. It's
Yep.
because I'm using points, and it's because I'm maximizing that card spend with everything else that we do, which I know that you help people with. If you're a going to do one of these, like a buy, even if you're not a business owner, you buy a property and you set it up. My one client, he was able to get almost 1 million points from $150,000 spend. I mean, that's a lot of travel. You can buy a lot of airline tickets with that, and that's what we use ours exclusively for. But it's a nice perk because, like it's a joke within my family. Like we want to go on vacation with Sean and Teresa because they'll pay for our first class ticket because the
Yeah.
points, right? And they're like, and so because we always let whoever comes with us, they get a nice seat as well.
That's awesome. No, but I think it's, you guys spend a decent amount. So like for you, you earn so many points, and like going straight on Delta. And I think a lot of times people are like, well, I don't spend that much. And how do I do that? And it's then thinking through, it's not just transferring American Express. It's thinking through, okay, on Delta, it might be 250, 300,000, but on Virgin or Flying Blue, KLM, Air France, like those are also partners
Yeah.
that you can transfer over. Yes, availability is a little tougher to find. Sometimes it may not be direct from where you're flying from. You might have to take a quick positioning flight. But again, it's that flexibility. If you aren't at that spend level, that's how you then do it. And I think that's where a lot of people get hung up who aren't spending a ton. And I like to be really transparent. Like we probably spend less than, on 10,000 a month. Like we're saved 50 grand over the last year in bookings just through some of those strategies of knowing, right, the who to transfer to, when to do it, how to kind of strategically align those. But again, it comes back to knowing when to open it right, budgeting, doing the right things. And for people who are just getting started, like again, that doesn't happen right today. That happened 10 years and it compounds just like Shawn's did 26
Yeah,
years in building Vodacy.
exactly. And you have to start somewhere. We all did. Like I didn't start with like, I could get myself into real big trouble right now with credit cards because I got three American Express cards that have zero limit, right? There's no limit on three cards I have. I can go spend $1 million tomorrow if I wanted. And so you have to have some discipline that happens and it doesn't, it can happen fast, but you have to start somewhere and you don't have to spend a ton of money. I mean, I have those points and we spend a lot of our points. I probably spend 3 million points a year on travel, but I have multiple businesses. We buy multiple properties every year. We do development deals, and so we're spending a lot of money, right? And so we're just utilizing those points systems, which I think is what you would tell people is like, hey, listen, it's out there. You're already pretty much paying the fees for it. As a consumer, it's already built in. Consumers don't realize that you're already paying that 3% premium anyways. So might as well get the benefit on the back end.
Yeah, 100%. Yeah, and you'd be surprised. There's a lot of people who are missing out on millions of points a year, but that's what I'm here to help do and
Yeah.
help solve. But Shawn, this has been great. I'm glad that you that you answered that hot seat question so well. I'm that honestly caps off the episode great because you're doing everything right, not only from a real estate perspective, travel perspective. So I love hearing how that blends together. But where can our listeners, find you?
Yeah, awesome. Just I appreciate that, Ross, and thanks for having me. By the way, it was a great conversation. I love these types of conversations. So if anybody's looking for more information on Vodacy or short-term rental investing, go to vodacy.com. It's VODYSSEY.com. And we have a ton of resources on there. I've got my book, our podcast, lots of free trainings that you can really dive into to see if you're like, hey man, I just want a little bit more information on this. If you want to talk to somebody, you can always book a call with our team, and we do strategy calls to look at somebody's situation, see if this is the right asset class. Like I always tell people, there's pros and cons to everything, including short-term rentals, and it's important to know what those are before you dive into anything. And that's what we're hoping to help people do here at Vodacy.
Awesome. Well, I appreciate you coming on again. This has been awesome. If you're a listener, if this is your first time tuning in, make sure you hit that follow or subscribe. That way you don't miss any weekly episodes that come out on Spotify, Apple, or YouTube. Also, if you don't mind hitting that 5-star review button, I think Shawn deserves one. That helps us not only grow the show, but keep these coming. And we will see you next week. Thanks everyone for tuning in.